Hey guys, this is Brian Jones. I'm here with Chris Hood, professional trader and the world's most interesting man with the world's most interesting hairstyle right now. I see
It's
that.
coming on, man. I'm telling you, this is why we have lockdown in Canada, is to avoid people looking at this hairstyle. I mean, it's just people need to stay safe, wear a mask, and don't look at Chris's hair. That's
Again, you're
the
just being comfortable. You're just being comfortable in your own skin. You just
you know, the last time I wore a pair of socks to actually sit and do something financially constructive was like over a year ago. In summer we wear flip-flops. I'm generally barefoot, and I've got a nice little heater here in my house where the vent is, and I can just put my bare feet on top of this. So I haven't worn any socks. I haven't had a haircut. I mean, this is just ridiculous. COVID's killing my style.
yeah, you're like a caveman, but with you're connected to the internet, making money on and trading options.
The next thing I need is to go keto or vegan. Then I've really just nailed everything. One of the two. One of the two. It's rent Tuesday today.
Rant Tuesday,
Oh
yes.
yeah,
So it's
rent
Tuesday the
Tuesday.
5th. What's sort of the market outlook you've got going on here?
Well, I thought yesterday was really interesting. First trading session of the year. And, we had that real toilet flushing sound right at the beginning of the day. Um, Positionally, we didn't do too badly. I mean, we actually came up for the day. Our Bitcoin positions came up. We've got a number of trades that actually went positive for the day. So net, I was up for the day, although the market was down. Um, Big problems, COVID coming back, version 2, like, will this ever end kind of thing.
Yeah, from
Plus, you've
South
got,
Africa. Thank you, Chris.
uh, you know, always be grateful for the third world. I mean, look, it's a hard thing. And when you actually look at some of these statistics, I mean, I'm not a virus guy sort of thing. I do what the government tells me to do. If it means I can get back on the mats quicker, I'll be, a lot happier. Um, but if you look at what happened down in South Africa, where you've got, the corruption of the government just stealing all the money that was going to go towards buying masks and things,
Mhm.
it's just ridiculous. And now you've got, yeah, I was reading in a newspaper about a big end of year school party sort of gathering of 18-year-olds down at the coast. At the height of COVID, no social distancing, no masks, nothing like that. And you've got these thousands of kids, dancing and raving, and then getting on airplanes and spreading whatever germs back in their hometowns. It's just, you know, I think there's two kinds of people in the whole COVID thing. There's the people that maintain a sense of community in terms of I'm being locked up to help others, and there's a sense of then there's the other group, which is I don't give a rat's ass, I'm just going to do whatever I like, sort of thing. And I think it's really difficult now because the people that were locked up for the benefit of everyone else are starting to get impatient, saying, well, look, you've locked me up for a year, I haven't really done anything, and nothing seems to be changing. And then you've got the other group that says, hey, look at me, nothing's happened to me, I got COVID and all I had was like two little runny noses kind of thing, and I'm okay, so why don't you come over? I think it's going to be really hard. And I think that we've lost as a humanity the ability to care because the numbers have got so big that, when someone says to me, oh, 3,000 people have died, it's like, well, okay, pass the salt kind of stuff. You know,
Well, it's
it
like anything else when something first kind of breaks off and starts, then you have a this overreaction, and then it just becomes. I mean, I don't want to use this term, the new normal, but people become desensitized to it.
yeah,
You can become desensitized to a civil war going on in your country.
absolutely.
You know.
Absolutely.
So,
That
how long has it been
desensitization.
since you've been back to South Africa? Do you ever go back?
I haven't been back since 2017. So it's been a long time, but my family are there. And, I get to hear it and, I'll talk to some of the family and some of them are like, well, we're not going to wear masks. This is ridiculous. It's an infringement on our liberties kind of thing. And the vaccines have got little tracking chips kind of stuff. And then you've got the other side of the family that says, well, you got to isolate, we've got obviously grandparents and everyone still around. And for the elderly, it's important for them to stay safe. And then you've got this government incompetence about rolling out vaccines and stuff like that. It's just, I don't know, man. I think at the end of all of this, when all of this is over and I'm back on the mats and I'm strangling people and I'm feeling a lot more human, I think governments are going to get questioned about the decisions that they made. And in hindsight, we'll be able to go and criticize and say, did they do the right thing or not? And I'm just glad I'm not a politician.
Oh,
I
for
wouldn't want to
sure.
have their job for all the money in the world. Please,
No, not at all.
not worth it.
So
Now
what do you,
you've got the Trump thing, the Trump thingy with him putting pressure on the Georgia guy. I'm wondering what we're going to see in the next week or so in terms of the final chapter. Like I
right?
read something
It's like
where
a big
Donald is going
political
to be.
soap opera.
Oh yeah, I mean, this is it's actually getting quite funny because I think what we're going to see is Donald going off onto an alternative news platform and taking his 20 million followers or whatever they are and charging them $4 a month to hear hear his tweets, and that might pay off his billions in debt. I don't know. I'll be looking for that at some point. But the thing that did strike me as quite strange is the step back of the New York Stock Exchange to delist some of these big Chinese firms that are connected to the military. I mean, they came back now and said, okay, well, we're not going to do it anymore. And I think that's an interesting geopolitical kind of dynamic. I mean, I'm no expert on these things, but I do find it interesting to see how, Canada captured that lady from Huawei and was going to extradite her to the US. And then the two Canadians got caught in China and they've been in prison now for 2 years. And, now you've got America saying, well, we're going to delist these guys because they're part of the military. And then all of a sudden they backtrack on that. I think it just, the geopolitical risk of the world is a much bigger, broader influence on the markets than we think. I think that we tend to underplay it. As retail investors, we tend to underplay geopolitical dynamics.
So how do you think this is going to affect the Chinese stocks? Do you think the confidence is going to be shaken, or investors still going to
It
be a little
did.
bit?
You know what it did is it did boost them in Hong Kong because that would be where their primary listings would land up being, right? So there was quite a big push on China Mobile and some of the stocks there over the last couple of days in Hong Kong. But now that they've reversed the decision to not delist China Mobile and these companies, I think it's like a warning shot. It's like, look, guys, if you don't play ball with us, we're going to do this. And the Chinese came back and said, well, look, we'll do whatever it takes, to defend their integrity or whatever it is. And I think as retail investors, you just got to be aware, and one of the ways to get away from that, to minimize geopolitical risk, is to start isolating stocks that are highly favorable by institutions. When you start looking at the big four, right? The big four stocks, Apple, Microsoft, Facebook, and Amazon, those are the stocks that institutions continue to accumulate day in, day out. Those stocks are not going to suddenly go to zero, right? But if you're buying some micro-listed Chinese electric car manufacturer that's got small liquidity, and all of a sudden there's a geopolitical thing, those are the stocks that get hammered. So you've got to, I think as retail investors, you've got to be really careful about what you pick and choose on. I mean, and
Is this from a strictly investing standpoint or from a trading standpoint?
I think from both. I think you've got to do it for both because, the whole, ever since 2008, the term black swan has become a lot more common in normal people's vocabulary. So when retail traders start, mom and pop kind of guys start talking about black swans and stuff like that, it was previously only the institutions that used to think about sort of these big 2 standard deviation risk kind of moves. But now that we've all felt them, they become common. We've just got to be careful about it. It's just about being conscious. It's not that it's going to happen. Statistically, a 2 standard deviation move is really hard to, it's really difficult, or it's got a very low probability of occurring. So you just got to be aware. I mean, I find for me personally, when I start doing sort of the longer term, where do I put my trading profits kind of trades, I'm far more comfortable buying a a stock of Amazon than I am buying, Nikola or any of these electric car companies. Would I put the money into Tesla? Probably not. There we go. I had to do it. Every Tuesday I've got to do at least one thing that's negative on Tesla.
Right. I'm just waiting for you to start shorting again.
Oh yeah, well we'll wait. When the charts tell me to do it, then we'll do it. I feel like a tarot card reader. When the cards say it,
yeah, exactly.
Oh, all I need now is some little crystal and a lava lamp, and I'm going to put some salt crystals here, so get the vibes right.
Right. I mean, I thought that's kind of where you got everything. I was thinking again.
Yeah, there's a couple crystals. I've got a yoga chair.
That works. That works.
Oh yeah, every hour my watch will beep and tell me it's time to stand up, and I'll go into a headstand in my yoga chair to just sort out my back. I have the world's worst back.
Sitting too long is terrible. I have to do the hip flexor stretch, where you do on the couch.
Yeah.
That's
I do that too when I watch TV. I sit and I try and do that between ad breaks. And in Canada, you have an ad break every sort of 3.5 minutes anyway. So you can time things. I think what I think is going to happen is we did see quite a run. All right. The last 3-4 months have been pretty good. Okay. And you get the first day of the year, there's this flush. One thing that I have noticed, I'm gonna see if I can pull it up here on my screen. There's a certain symmetry to the market and the way in which the market sort of flushes out every couple days, right? So let's just look at this for a second. Here's the big one, all right? This was last year, done, all right? But just have a look at the frequency at which we get these little drops down, right? So that one, not too bad. That one, not too bad. That one, not too bad. But this one all happened over a period of around 8-9 weeks. There was a pretty big one. And if you calculate the distance from there to there, that's sort of beginning of April, let's round it up. There's 1 month, 2 months, 2.5 months. So you're looking at around 60 days, somewhere around 60 days on that cycle. Then we had another one over here. Then we had a long run of about 3 months and a big one. Then if you look here, there's September, there's 1 month, 2 months. There's another one. There's a certain timing symmetry. I think you could probably average this out. Every sort of 40, 45 days, there or thereabouts, you should expect the market to sort of flow back a bit. So this is not unusual. And I think yesterday there were particular stocks. There was one, I think Starbucks was one that I added more to my position on Starbucks yesterday. This is great. This is fantastic for traders like me. When this happens, let me just move this over a bit. A lot of retail traders look at that and go, that's it, I'm gone, I'm out. They lose. And obviously the people that have bought short duration out of the money call options, they got spat out here, right? Those options have just been killed. So if you look at the way to trade trains that look like this would be a long call option or a debit spread. But when you buy them, you need to be going out 90 days, 100 days, and a delta of around 70 to 80, somewhere around there. These kinds of pullbacks are really helpful if you've bought 1/3 of your position somewhere here. When it's a pullback to the 8 or a pullback to these moving averages, you buy another one. So now you've got these 2 contracts that you've had in place here at a lower price. There's the pop back up. So those 2 contracts are now worth more. You could take profits at this point, or some of the profits, you could halve the position, pull back, add another one. It rides up again, take profits, pulls back, add another one. So you have to trade the pattern. The problem with a lot of retail traders is this kind of action, they start thinking about recency, right? And recency bias is a really big problem for a lot of beginners because they think if this happens, then this happens. They think that this is going to fall all out of bed. They don't recognize the history of the stock. And if you look really carefully, every time Starbucks pulls back to the bottom of this Bollinger, it comes back up. It comes back up. It comes back up. Look at that. It tracks this pretty reasonably. So what could we expect? Well, we could expect this to come down here to a 99. That's not a huge gap from the 102 where it is now. It could come back down to the 99, and it will probably drift back up again. And if you start adding, just some simple Fibonacci here as well, you get to see, let's look at some, we can add one over here. It's a bit cramped. Finviz is not the best when it comes to doing this. But if I look at that, you can see it's fallen right through the 61.8 down to the 50. Now we want to see how it handles the 50. I know that the 99.6 will more than likely be its area of support. So if it did get to 99, I'd be buying another one. But most retail guys would look at that and say, oh, no, it's going to go all the way down here. They'd be looking to enter down here. And in fact, psychologically, they won't even enter over here. They will enter when it gets all the way back up here. So normal, uneducated, novice retail beginners tend to be very limited in the application of some of the trading techniques around swing trading and around recognizing reversals and opportunities to get in. They always tend to get in too late and then they get out too late. So they're never getting the full value of a trend.
So I know you have different types of trades. You trade momentum, you trade positionally. Yeah. Is this more of a positional or a momentum?
This would be a reversion to the mean, right? So let me just reload this and get rid of that Fibonacci and we'll see. Okay. So what you want to look for is, this is a significant trend. So if you just look at this without even doing anything, you can see that the trend is from the bottom left to the top right. So we know that this is within a trend. It's got its channel already created. Here's this blue line that comes in. Here we have a support line that's pretty much indicating at 70. So this is not really that important for us. It's a bit too far out, all right? That's really where we would be looking. To bottom of that channel, this Bollinger, this moving average. Now, if Starbucks does tend to fall and it goes down here, the trade I'd be looking for is to get it back to the moving average. I want it to go from that bottom back to the moving average. Depending on the Fibonacci lines that I'm using, so let's say it falls all the way down to 0, a reversion to the mean might be just from 0 to 38.2, done. And based on the volume metrics, based on the squeeze indicators, based on all of those things, we would be able to work out from an expectation perspective, not from a certainty, but just from an expectation, where am I thinking this is going to go? Because if we start adding in some of these additional indicators, Finviz doesn't have it, but when you start looking at some of these alternative indicators, you can see where momentum is going. And momentum doesn't last, it doesn't permanently stay in a downward trajectory. Even this period of disaster here, there were still days of green, right? So even when you think the sky is falling, there's still green. People are still buying this stuff, right? So when it comes down, reversions to the mean we know where the institutions are going to be buying the stock. We can see on the graph that when it hits this dark orange line, there tends to be days of accumulation, right? So it's past this orange line. Orange line is dropping. You can see it's going to be dipping below this pink line. So that we call a bearish divergence. It's going over the line. So your faster moving moving average is now dropping below a slower moving average. That's negative on the price action. Just the price action. It just means for this period, we're going to be careful. You might see a dip and then it will come back. So for here, I'm expecting Starbucks to probably, let's have a look at where it is right now. It's probably going to open up flat. This is not a huge movement at all. There might be some buying that will go on. It will push this back above the orange line, back into that trend. And the reversion to the mean is more the movement from a Fibonacci layer of support towards the mean of the moving average or through the next line of resistance. So when you trade those, you can take two different, you've got to have really an idea of timing, right? It's not every stock will fall, hit zero, and bounce straight back up. Some of them fall and then just boom, 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 like this. They just bounce around. Some of them will fall, bounce, and then fall again. Some of them are going to fall and bounce hard. So you've got to know what that stock does, right? You've got to look at its past, look at its history, see its symmetry, and decide for yourself. So let's have a look at previous times where Starbucks has fallen. So it fell here, bounced around, then moved up. It fell here, bounced around, moved up strong. Fell, 3 days of bouncing, moved up. Lots of compression. You can see the compression here, by the way. You see how it compresses and then explodes up. So this indicator, the TTM squeeze indicator, the one that I teach you how to use, that would indicate, you would be buying your position here. You'd accumulate your position probably in these areas here on the pullback, there. You'd be buying, this would have given you a bit of heat. You would be buying here at the bottom of the Bollinger, bang, price explodes. Bottom of the Bollinger, bang, price explodes. So you've got to look at the graph, go back a little bit, have a look at how it's behaved in previous circumstances. Understand where you have these big buying days. So look at the volumes and correlate that to price movement. So look at that one. We had some big buying on that day, but yet the price went up and then it fell. We had some selling the next 3, 4, 5 days. Then we had some buying, a lot of buying. Now we had some selling. It's just, there's no real hard and fast rule other than practice. Get comfortable looking at these. I always say to people, graphs are like a storybook. There's a story that's being told here. And different people will interpret these stories in different ways. Some people will see a different language than you. But every single one of these candles is like an alphabet letter. And they tell you something. You put these all together, they string a sentence. And when you string that sentence together, what do we see here? Well, I see a stock that's moving from the bottom left to the top. It's in a band. It trades close to the moving average. There's been a pullback. Very simply, it's a buying opportunity. Now, you could look at your positions and go, well, if I get another day, excuse me, if we get another day where this just chops around here, this chop, great for bull put credit spreads. Great for bull put credit spreads, particularly if you've got this compression forming. So if the Bollingers were tighter, let's see here, if you've got this kind of impression here where it's tight and it's moving across, bull put spreads, because what you're looking for is the bull put spread to be eradicated once you get that price movement to the upside. Now, bear in mind, when you've got this compression, there's no certainty that the price will go up, because compression and momentum don't give you direction until they start firing one way or the other. So you'd be watching the indicator, and if the indicator was showing a little bit of green, meaning momentum is going to be moving to the upside, you would be going, bull put credit spread here. You could be a long call option, whatever it is, you could go long.
So you like to layer trades on the same ticker occasionally, so you'll have
I do them fairly often. You know why? Number one, I'm lazy. So I don't really want to do a lot of work, and having one stock to look at for 4 trades is much easier than 4 stocks to look at with 1 trade each. So, there's that. The second thing is I like to use debits and credits to minimize my risk. So if I just buy a long call option, obviously the risk is the debit paid, right? And if I've done it as a as a debit spread, I've paid less, right? I will often, on stocks that are highly, strongly bullish with strong momentum readings across the different time dimensions, right? So I would usually start 5-minute chart, 15, 30, 60, 2 hour, 3 hour, 4 hour, see how the momentum is building across the time frames. I might have 2 long calls, 3 debit spreads, 2 bull put credit spreads, a naked put. I could literally do all of the strategies if the indicators are telling me price is going to move up. And
so you're identifying a really strong stock as opposed to trying to spread your trades out among a bunch of different tickers.
Different expiries. All right.
Yeah.
So remember this: each option trade has a different success rate. Right. So if you've got a stock like Tesla, for example, Tesla for me was a pretty bad stock to trade at certain parts of last year. I made it back, but there were times where I was choosing the wrong strategy for the stock. There were certain strategies that worked better, and you start to see that with certain stocks and certain graphs. Different types of strategies will work better than others. Right? I don't use iron condors, for example, because I find their risk reward too small, and I find that the timing can be off. Right, so any sort of huge volatile movement, can kill you in a condor, right? Because what you want is the stock to stay within those two bands, right? I don't want it to move too far up, and I don't want it to move too far down. And any extreme movement in one direction can kill that trade. So I tend to stay away from things where my statistical probability, and the only way I can work out my statistical probability is to track my own performance. All right. So I watch my own data every year, every week, every month, and I know what strategies for me have been working on what stocks. So I know that when I trade, let's say Twilio, for example, bull call debit spreads have worked a charm for me on Twilio. So if I get a signal from one of the systems saying Twilio is a trade, and it's meeting the setup requirements that I have in my trading plan for bull call debit spreads, I know that I've got a pretty good rate of winning on Twilio for bull call debit spreads when I set them up in that particular in that way. So when you're setting up trades, a lot of retail guys are seduced by risk reward. It's an incredibly seductive topic. Like if someone said to you, Brian, you put $10 down and you can make 3,000, eyes light up. Everyone gets excited.
Oh yeah, for sure. Like, who wouldn't want that?
But the problem is that the chance of you making that 3,000 is like a 1% chance. Right? There's a 1% chance. Take a call butterfly, for example. Call butterflies, when we start doing the 1, 2, and 1s, and we look at them based on the implied moves and we calculate them correctly, etc., etc. The max gain on many of these trades is like a 6 times, 7 times what you put in. Highly attractive, but your probabilities of getting to that 6 are actually pretty low. Where I like to tell my guys to go towards is maybe a 2 times or a 3 times. So I'm not even asking for 100% of the max gain. I'm just looking for 50% of the max gain. So when we do a butterfly, I know there's some guys that will say, no, you must hold it to expiry. And I get that. And there's certain trades that I will hold to expiry. But by and large, if I've risked $200 to make $1,000 or $1,400, and I'm sitting on a $600 profit and I've got 3 days to go, you'd be stupid not to take the money off the table and reset the trade.
So basically, you don't want to give your trade time to screw up since you're already ahead.
Perfectly put. Absolutely.
I was kind of curious though, because I was wondering if there's any. I was on a chat group the other day. It was recommended by a friend, and they basically only traded iron condors.
Oh,
what do you think about?
You just poked the bear, Brian. Poke the bear, man.
Do you think that chat groups are useful for people to get ideas or to listen?
Man. If there's one thing I try and encourage people not to do is hang around with idiots. Right? Seriously, there's you'll probably know this, right? In psychology, I get it. In COVID, under lockdown, you become the average of the 5 people you spend the most time with, right? So mine is my wife and my 8-year-old. So I have to manage it, right? I think my wife is bringing me up. Okay. But here's the issue. Most of these chat groups, I look at them as, self-promotion kind of things, right? Really, really good traders don't spend any time in chat groups.
Those
And
guys
remember,
are winning a lot of money. They're talking about the trades they win.
well, the thing is, they might tell you that, but if in reality, then if they were that wealthy and that rich and that successful, they wouldn't be in chat groups either, right? So
Good
it's
point.
almost like I'll tell you what the problem is. Your trading success is almost guaranteed based on your trading plan. If you have a trading plan, and statistically, remember this, you still have a high probability of hitting a losing streak in a trading plan, right? Doesn't matter, everyone hits them. So let's imagine you, Brian, have a trading plan and you're in your losing streak and you're on this chat group with Johnny No Mates and Frankie No Friends and all of those guys who've been, doing their $10 a month, options course or whatever it is. And now they consider themselves to be experts on, retail strategy, number one, easiest to sell, first way to blow up your account, naked puts, right? And they've been picking these naked puts and they happen to have just picked a small sweet spot. Their account, they've had 10 winners in a row. Now, all of a sudden, they're the world's best expert on naked puts. And they go onto their little chat group and they're telling all their mates, I just cashed out. I just made this. I just made this. I just made this. And you're in your losing streak and you've got your plan and you've been trading your plan. What does that do to you? You start doubting your plan, the one that you've spent months developing, that you've been trading and you've had success with. You've just hit that little patch that everyone hits where you've got this losing streak. And Frankie No Friends is telling you how successful he is. And don't forget, he's also the Uber driver and he's also, delivering pizzas or whatever it is, right? So he's so successful that his trading hasn't taken him out of where he is, right? You doubt yourself.
That's a good point.
Yeah, you doubt yourself. So now you go, you know what? I'm going to ditch all this work that I've done on my plan. I'm going to now follow Frankie No Friends. And whatever Frankie No Friends does now, I'm going to do. Now remember, Frankie No Friends hasn't hit his losing streak yet. You've hit yours, but now you're going to him. And it just coincides that Frankie No Friends now hits his losing streak. So now you've lost. You've ditched your plan. You're now following Frankie No Friends. And Frankie No Friends hits his losing streak. Now what are you going to do? You have nothing to fall back on. Psychologically, your trading has now gone back to zero. You start again. You've blown out your account. You've lost money. You've lost your no friends friend. Okay. I'm not going to follow Frankie No Friends anymore.
Probably stop posting at that point because
probably. This is where it all starts to go wrong for people. Is that I know that I'm a pretty expensive guy to have on your side. All right. And I'm a very conscious person around the value that I create. For 99.9% of my clients, they make back my fee in the first month and it's a self-funded operation, right? They make more than enough than what I charge. The problem that I get is where people pay the fees, but don't do the work. Then I always say to them, well, what are you doing this for? And remember, trading always comes down to this ego. It's an identity.
Do you have people who pay you and then they don't do the things that you ask?
Yeah, I get that all the time. And I say to them, I'd rather you stopped. I'd rather you just stopped because you're convincing yourself. What happens at that point is they'll look at their results at the end of the year and they go, oh, didn't work. The coaching thing didn't work. The trading thing didn't work. No, it did. You just didn't do the work. And it comes down to these things. If I take a trade, any trade that I've done, and you see them in real time when I do them, and you know exactly these are the numbers, right? If I take one trade and I put 5 people in a room, I give them the same trade, I'm going to get 5 different results. Because what people forget is the emotions of the person hitting the keys. That's the biggest deciding factor in whether you will be a successful trader or not. It's got nothing to do with me. All right. I can take a shitty stock and still make it a decent trade. All right. We can still fix things. We can fix positions, right? You've seen how we do that. The problem that most people have is they want to go too fast, too soon. They want to get onto the supercharged Kawasaki bike before they can ride a tricycle, number one. And number two, they're not willing to do the licensing, right? They're not willing to do the work. I believe you need to do at least 30 days of just paper trade to understand yourself rather than just understanding the trades. You need to know how you're going to react.
I don't know of anything that you can get good at and not practice and not
Yeah, I
study.
agree. Think of
I've never
jiu-jitsu. Could you imagine some dude walking into a jiu-jitsu club going, I want to take on the black belt, and he's never done it before?
That's
I'm like,
happened.
buddy, don't worry about the black belt. Take on this 4-stripe white belt. Let me see how you behave with him, and then you pull
That's
your
why you have
gorilla
to like
out.
that's why if you run a school like I do, you have to have you just have a cadre of people that are like the enforcers. It's like, well, if you can beat up this white belt, then
Yeah.
well,
Oh, it's a really big issue for me because, when I first started trading, I had no one to teach me. So I was self-taught. Going back 15 years ago, I was self-taught on all of this stuff. And what I found was if I'd had someone hold my hand and tell me to do the right things, like just tell me what to do, rather than me go off, spend money to lose and learn the hard way, I would have been much more successful. And I see that as what a coach actually does with trading. I'm not here to just give you trades. Yeah, I can do that. But the real thing is to get you not to make the same mistakes that I've made. And often what I see with a lot of people is they'll make the same mistakes. Even though they've got someone that's telling them, don't do that, they'll go and do it. Sometimes that's the only way people learn. So yeah, these chat groups are not good. I would never ever suggest going onto a chat group and bragging about your performance. I mean, like that to me is just vulgar in any sense. What I would suggest though is make sure that the people that are on the chat group are better than you. Then at least you'll be learning something.
right. I've seen a couple of actual. I'm not a member of any chat groups. Although on Reddit there are a couple of forums that do have some decently intelligent people on them.
Yeah, if you
explain.
I have a.
I don't make the trades that they suggest.
No, I don't either. I have a community of people that I can talk to once I've looked through my data and I can see a trade that was a problem. I will call 2 people and I'll ask them to have a look at it and tell them, ask them to tell me what they see, what was wrong with the trade. But usually I can work it out for myself in the calmness of a weekend. When the market's not green and red, green and red, green and red, I can look at data and I can say, well, maybe on this trade I could have done this. And
it's a peer group of other professionals that are really good.
Yeah. I will only trade with people. I will only discuss my trades with people who know more than me.
I mean,
otherwise, what's the point? There's no point for it, right? Sorry. No, you go.
Well, I had a question. So the other, it was on a webinar you were doing, and you were talking about setting alerts.
Yes.
Do you want to talk about the value of using your platform to set alerts for various things?
One of the things I do with my planning is at the end of each day, I will go through each position. I will look at all of the charts. I'll look at the hourly, the 2-hourly, the daily, all of them. I'll look at how they are performing or what they are telling me, and I will update my plan for that trade. You've seen it because I send that to you, right? So you've seen how each day I look at the trades that are expiring in the next 30 days, and I'll have actions that I'm going to be taking. Or maybe there's nothing. Maybe it's just hold. And what I can do on Think or Swim is particularly useful for this. Most of my alerts are triggered by price action of the stock, not the option position, but the stock. So if the price of the stock is moving through key layers on the Fibonacci going up, I have an alert that will ping on my screen. Stock ABC is now above the 38.2. And what I would have done is added a small annotation to it saying it's above the 38.2, buy more shares or buy another contract or exit or look at the charts and decide on a new profit target or take out half or add 50%, whatever the action is.
So you've already made the decision.
I've already done that.
A little note to remind you.
Yes. In the calmness of the day, after the day, I can make those decisions. So during the day, I don't have to think. I'm not thinking about ooh, GME is up here. Should I do another trade? I'm not doing that. Most of the trades that I do on a day, I've already pre-selected them the day before, and they are conditional on certain actions taking place the next morning. Price up, price down, bounce here, bounce there, whatever it might be. So when that happens, my system will tell me, and the little note will come up saying, last night you said you were going to do this. If this happens, okay, well, now you've got to go and do it. And then without emotion, I do it. And at the end of the day, I'll go back, look at the position, I'll update my ledgers, I'll be able to see, I added more over here, I added more over here. And you tend to trade then more in a calm way. I'm not nervous. I don't.
You make your plan when your judgment's not clouded by
Absolutely.
emotion, and then you execute it whenever
Absolutely.
it is. That's like the opposite thing of holding people accountable to do all those things they said they're going to do when they're drunk. They're like, I'm going to start doing this. And you're like, okay, I'm writing that down. It's like, make good on it. You said you were going to do it last night when you were drinking.
You said you were going to give me a Bugatti last time you killed that Jack Daniels. And where is it? Yes.
Exactly.
The thing with trading is that you're not a better trader because you're you actually are a worse trader because you're an emotional person. So if we understand before we trade that these are the things that can get in the way, okay, well, how do we avoid having those things get in the way? Well, we've got to take ourselves out of the situations where that becomes the prevalent sort of behavior cause, right? So to do that, you've got to plan outside of the market, not during the market. Because when the market's moving and suddenly you're looking at your net liquidity on your account is down 40 grand and this, what are you going to do? You're going to be focusing on your P&L and not making good decisions for the position that you have. And that's when people exit too early. Market's gone down the toilets. Let's pull everything. Well, some stocks stay up and markets go down. Just like yesterday, we were down 600 points. Our positions were up. You've got to learn to understand. Well, you've got to learn to control the things that are going to make you a worse trader. It sounds very counterintuitive. Like, let's focus on the things that make us better traders. We are not good traders by nature. We have a primal instinct in our brain called fear and greed, and these two things can sabotage you before you even know it. So the only way to get rid of fear is to have a plan. The only way to get rid of greed is to have a plan. And if it's not written down, there is no plan. Then it's just random knee-jerk reactions. I love it when I have beginners tell me their trading plan is all in their head. I go, no, it's not. And I can't fix a trade, or I can't help someone learn from a trade unless I know what they were trying to do in the first place. And when I sit with someone and they go, oh, well, I did this and I was going to do this and I was going to do this, I go, show me in writing. Show me where you wrote that down and tell me what you saw when you did the trade. Because you have to match expectation with the story of the graph. And if I look at the graph and I look at what they were trying to do, and I go back and I can just see the date at which they tried to do the trade, I go, well, this is what they were looking at, and they expected it to do this, but the market did this. On what basis did this data here tell you that things were going to go that way? And that's how you teach people how to read graphs more accurately, is to understand where their expectation was not really aligned with what was happening. So, a lot of beginners will call me and say, oh, my profit target was 50% and now I'm out at 50%. Awesome. Show me where you wrote that down, where you said 50%. Oh, no, it's all in my head. Okay, so your profit target wasn't that. What actually drove you was I made 50% and I was nervous I was going to lose it. Because a percentage profit target doesn't necessarily correlate to a price movement on the stock. Because remember, an option can be repriced with volatility. It can be repriced with intrinsic. So there's all of those factors going in, right? So volatility could spike, the price could stay flat, and the option position will go up. The price charts will tell you when to get out. So when the price hits that level on the Fibonacci, that's the plan to get out. When it hits 38.2 and my profit target is it's at 60%, I'm out. It's hit
Could
the
a
price
person
level.
have a plan to get out at a particular target or
Yeah.
50%?
Most times it depends on the setup, right? So if I've set up the trade and it's bouncing off the zero line, so it's retracing back up from the zero line, my first profit target would be 23.6. When it hits the first level, depending on how many contracts I have, I might exit half, keep half, I might add more. It depends on the stock. So
Right.
something big like Apple,
But you have
maybe
to have a plan. You have to,
everything. All stocks have a plan, right? So if it's a small cap, not the most liquid stock, I might just take that first move and get out completely. If it's a stock like, on our book for the week, we had Berkshire Hathaway, for example, and we have JP Morgan. If I'm going to be doing those, I might be adding at the 23 level, at the 38, at the 50, and then taking profits at the 61. So it all depends on the stock and it all depends on the graph. If the graph is telling me that there's going to be a long run in terms of retracing back up, yeah, I might take profits, exit, wait for the stock to get above the resistance line, 2 closes above, buy more. Now I'll go back in. So I get out whenever, if I'm hitting a point of resistance, I want to probably pull off my positions or halve them, wait to see how the stock behaves around that resistance line. Once it moves above, 2 closes on the hour above, I'm in. I go back in. As a trader, you don't win by capturing 100% of the whole move. I only just want a chunk of it. If I just get 65% of the move, I'm happy. If I get 50%, I'm happy. And because we're using options and it's leveraged returns, just capturing 50% of that movement can be very rewarding for us. So all of that's written in the plan.
so
Because your plan is your approach. It's how you address these things. How do you make your account grow in value? It's the same thing when you've got a winning position and a losing position. There's sometimes with winning positions, I will exceed my allocation goal because the position is working. But I will only do that on positions that have got, 100 days more to go, 300 days to go, maybe a leap. If you're buying a 2-year contract on Apple and you're up 40% on your first position, put more money in. There's nothing wrong with that, right? You just keep adding into those winning positions because as much as you're going to lose on some of these smaller positions, when I win, I want to win big. I want to compensate me for all of the small little losses that I'm taking. So there's some really, really good books on Amazon. Where
what are some good book recommendations that you have?
Where is my Kindle? I'll pull out my Kindle for a second and I'll do it. In fact, I want to put a sort of list together, and I'll give it to all you guys as well. On the let's have a look for. So one of the books that I've had recently, it was called The Talking Chart by Vasil Bankov, I think it is Banov. Let me see if I can pull it up on Amazon for a sec. Hold on. Let's go to Amazon. This was a good book. I just read this weekend. I thought I really enjoyed this one actually, because what he talks about is that how each Holy Basil leaves. Hold on a second. Let's see the talking chart. This book here, he talks about how the graphs speak a language. And I was like, wow, this is actually a really interesting way of describing how the charts are. So he's pretty good. There are a couple of other ones. Let me see, which was the other one? The Option Traders Hedge Fund was another one. Like this one here, this book as well here, I thought was excellent. It's quite detailed. They go into quite a lot of detail around volatility and all of that. And they've got specific, 2 or 3 strategies that they use, but it's how to create a one-man insurance company. So, you're your own dude. It goes through business planning. It goes through the whole process, what trades they're going to do, how long they're going to hold them for. It's fantastic. I really like that book. So, having a look at that, I have to say in this game, this book is fantastic. I'm a big fan of Ray Dalio. The biggest problem with books is there's a lot of repetition because there's not a lot of new stuff. There really isn't. A lot of these books are self-published. So if you're a bit of a grammar Nazi and you don't like people who use bad syntax on sentences like me, it can be really frustrating reading some of this stuff because it's
some of the self-published things they have great content, but they don't really copy edit them very well.
Yeah, but a lot of this stuff is all the same. There's not a lot of new material when it comes to options trading and how to make a good strategy and all of that stuff. There really isn't a lot of new material. It's just basically repetition. And I mean, I think on last count, I've read 651 books on option trading. That's my total collection. And
I like that
some of them have been
651 books.
651 books.
You have a spreadsheet for that.
No, it actually tells you in your Kindle. So when you've downloaded it, it tells you how many you've got in each collection.
You're a data guy.
Yeah. Well, the thing is, if you want to get into a subject like this, you have to commit to it. This is not a hobby for me. This is something that I spend pretty much every waking hour doing other than my jiu-jitsu. These are the only 2 things that I do. And if you get into this topic and you go into trading, you've got to commit to it. This can't be something that cures boredom or, when I see people who've got just a lot of money throwing it around and losing and laughing about it, it drives me insane. Absolutely insane. This is not something that people should take lightly. It's a very important thing to me. It's not a hobby. So, that book's a really good one. You got to read up. You got to continuously learn and challenge the strategies that you're doing. I'm constantly looking at what I'm doing with the mindset of it has to be better. How do I get better? And one of the things to think about when you're trading is measure your losses, your average losses per trade, measure your wins per trade, and look at the difference in value between the two. So just divide your wins by your losses. And your ratio, the greater the number on your win side relative to the smaller number on the losses side, it's that gap that's going to grow your account. Because most people look at win rates, right? But if I had a 70% win rate, but I lost 25 grand on one trade and I was only making $50 on each win, I was never going to make money, even though I had a 70% win rate.
Going broke as a winning trader.
Absolutely. And this is why you see guys, like Paul Tudor Jones and all of these really, really famous, wealthy hedge fund guys that have got billions have win rates that are no better than 44, 45%. Because when they win big. And when they lose small. And it's that you've got to keep in mind as a trader. My trade win rate for last year was just over 62%. My win to loss ratio was about 1.3. So every time I won on a trade, I was winning 30% more than what I was losing on average on a trade. That 1.3 is terrible. For me, no, I wasn't happy with it. I was still profitable for the year, but I'm not happy with that 1.3. I would like that to be 2.3 or maybe 3.3. So a big focus for me this year is managing these losing trades. So even though yesterday I had a loss trade on something, my loss was $7. it's not a huge thing. But I also had a winner yesterday, was 800. So, big difference in those. That's what I'm looking for, is that gap needs to widen.
That's a good talk. Maybe next week we can talk a little bit more about some strategies for managing losing trades. Just
sure.
But well, Chris, it's been a pleasure.
It's always good to see you, my friend.
Yeah, you too. Stay safe up there. Keep that hairstyle going, and we'll talk to you next week.
I'm going to blow dry it for you, especially next week. I got to do something, man. It's just it's like a bird's nest.
All right, man. It's all right.
I'm waiting for the Canadian geese to take up house.
You do you, Chris. You just be yourself.
It's good to see you, Brian. I'll speak to you soon.
All right. Take care, Chris.
Take care, buddy. Cheers, man.